Hey everyone, super happy to be here on the Blushing Quants. Today, I'm very, very excited because I brought you a very interesting guest from Spain. And he's going to be talking about like options, market making. And I'm very, very excited because, in the Blushing Quants, we really like to take conversations, to where it leads us. And I think that conversation is going to be very, very dynamic. And you'll guess it's dynamic sense during call, and you'll see how we're going to be diving to topics, how deep we're reaching, and so on and so forth. So without further ado, Antonio, es un placer. Gracias por
Hi.
veniste, and very very happy to have you here.
Hello, Afek. Hola. Es un placer.
Hola, hola.
Also for me, it's a pleasure. I'm very happy to be here in the Blushing Quants. Thanks for inviting me to this podcast, and yeah, we'll be happy to share interesting things about options trading, market making, etc.
Sounds brilliant. Sounds brilliant. So before we start, let the audience to know a bit more about who you are.
Yeah. Well, I'm Antonio. I was born in Alicante, in Spain. Um, my background has been I studied electrical engineering or telecommunications engineering, depending where it is the degree, and mathematics. And then I went into a PhD. I really went into the academia path. At that time, my idea was to become a university professor. So I did a PhD in computational electromagnetics. I was going to conference, everything. But towards the end, I felt that maybe the academia was not for me. I was ambitious, wanted something else, and a friend told me about quantitative trading, like basically using math to take trading decisions. And I started digging into it and said, "Wow, this is for me." And I really became like quite passionate and obsessed with the topic, and I look for ways to enter in the industry in a proper manner. So basically, I studied a master's in quantitative finance in Madrid. And there in Madrid, I started working in portfolio optimization with quantitative techniques. But soon I realized that even though, there are some opportunities in Madrid, really, I would consider the interesting stuff was being done elsewhere, like I would say London, Amsterdam, Zurich. So after doing some research, I found that particularly in Amsterdam, there was a lot of options trading. At that time, I was already introduced to options, and I was fascinated about the multidimensionality, the flexibility, and the different ways of trading options. And therefore, I started looking into options market making firms, and then I joined one company in Amsterdam. There, I spent about 6 years on this market making firm, and I participated in both on the market making, pure market making, screen trading, brokers side of things, like basically the actions in all the trades, like pure market making activity. And then probably because my research background and because I understood like well the research processes and signals, I joined together with other people, and we kind of build again a team that was responsible of taking positions or taking views from the market makers, basically not closing a position, which is what the market maker does. The market maker doesn't want to hold the risk, just small spreads. A position taker, it believes in some position has some alpha, and it wants to you know
Mhm.
take all that profit. So I saw all these two ways instead from a prop trading market making firm. And then after that, and because I already was trading crypto myself, I was interested in all referring to blockchain technology, etc. I joined also a market making trading slash uh,
Mhm.
investment banking uh, firm for crypto.
So
Yeah.
I have a question, but it's going to be an intrusive one. So before I'm going to be asking my question, would you like to post your disclaimer?
Oh yeah, yeah. I'm gonna just say my disclaimer. I have it here. yeah, the views, opinions, analysis, and comments expressed in this podcast are solely my own and are provided in my personal capacity. They do not represent, reflect, or express the views, position, strategies, or opinions of my employer, Kirok, any of its affiliates, clients, partners, or any organization with which I am or might be associated. Nothing discussed in this podcast should be interpreted as investment, financial, legal, tax, accounting, or other professional advice, nor as a recommendation, solicitation, or offer to buy, sell, or hold any security, cryptocurrency, derivative, financial instrument, or other asset. Any reference to markets, companies, projects, or investments are for informational and educational purposes only. The information and opinions expressed are based on my personal understanding and judgment at the time of recording and are subject to change without notice. I make no representation or warranty regarding the accuracy, completeness, or timeline of any information presented, and I undertake no obligation to date or correct any statements. Listeners should conduct their own independent research, seek advice from qualified professional advisor where appropriate, and make their own decisions based on their individual circumstances. Any investment or trading involves risk, including the potential loss of capital, and past performance is not indicative of future results. By listening to this podcast, you acknowledge that you're solely responsible for your own decisions and that neither I, nor my employee, nor any affiliated parties have set any liability for loss, damage arising from the use, reliance, or information, opinions present herein. All right.
Okay, guys. So as you might understand, no recommendations, just a mutual conversation between two individuals, no relation to any type of institution, so on and so forth. So with that said, we are able to go. So you were starting at, you had a little incentive or a little fascination, going from quant trading to option trading, and from option trading to option market makers, and you were looking for a solution in the market making world, in the world of options, which is the thing that I think, out of my perspective, that it's highly, highly, highly interesting, to ask you, how does, market makers in options are actually making money? What's their like, from your insight, what's their business model, and how market making, you know strategies like coding algorithm and so on and so forth are actually applied, with option trading, because now you have, like, contracts, you have premia, and more associated costs that you need to take into consideration. And my belief is that you would have to refine where the bottle is supposed to be, even slightly different than regular market maker. So yeah, I want to hear your opinion about it, how you create an alpha, how you increase the margins as an option market maker. And let's dive in. And I told you it would be intrusive. I'm an intrusive guy. What can I do?
Yeah. Yeah, sure. I mean, to understand options market making and how it can be profitable, I think it's good to, let's say, go 2 steps back and think in a single asset market making, right? What the market making does is, okay, well, I have this asset, which, because of the trading prices and how the market is positioned, I believe has a fair price of 9, right? And I'm willing to buy it at 8 or selling at 10. Now,
Mhm,
if a seller comes and finds liquidity on my quote, which I'm providing, and I buy it at 8, well, ideally, um, I want to find someone who's gonna, buy it from me at a higher price, so I don't hold that risk because I'm not interested, or generally I don't have opinions on the direction of the asset, right? So if there is enough genuine flow mean market participants who are, willing to buy or sell the asset by their purposes, they are not market makers. uh, you will find that maybe, you hold this asset for certain amount of time, minutes, hours, maybe 1 2 days, and then you find a buyer who you're going to sell it higher, right? And you make the profit of that spread, right? So let's say you buy it at 8, and 1 day later you sell it at 9.5, you made 1.5 profit, right? It sounds easy.
mhm,
Probably when the markets were less developed, there was more opportunity. Nowadays, everything is more competitive. Now, what happens if, okay, there was a seller on that asset, but there are not buyers on that asset, but there are other correlated assets? Well, maybe I'm just buying this asset, And to hedge my risk, because I'm not interested again in direction, I may sell a similar asset. So think, for instance,
Antonio, a quick question. Correlation, but what measurement? Correlation to Sharp, correlation to benchmark, correlation
correlation in terms
to an
of
index.
correlation in terms of the direction where the risk is. Like for instance, think
Mm,
on a stock, right? Let's put a very very specific example. So let's say you are market making bank stocks, right? And then you buy ING Bank, uh, this Dutch bank. Well, probably you're holding this risk, and if you cannot offload the risk in the same product, this is an ING, maybe well you can sell a correlated bank, which can be ABN AMRO in this case. And
mhm,
if there is no bank available, probably you can find another security, maybe some insurance company, which correlation is enough. Or in general, equities are quite correlated. So basically, it's complicating a bit the framework where you might not find the exit liquidity or flow to offload your risk. And as a market maker, again, you just want to close the risk, keep the spread, and keep moving, right? You don't want to hold risks. Also,
mhm.
the faster the cycle, the faster you get rid of the risk, you can get into new risk, right? Because you have some risk limits. So you want to do this cycle as fast as possible. Find immediately somewhere to hedge, unless you have a very good reason or signal to believe that okay, that direction might be good for a while, which is another topic. Just mixing position.
And that risk, as let's separate it into risk windows and taking into consideration every risk window and understanding that in the current window the risk is a bit deviating, and you understand that you need to deviate with the risk in order to apply it into another window. How do you find liquidity? Because you were talking about correlation, you're talking about less efficient market where you have only buyers or where you have only sellers. And I want to understand what you're actually doing and how you consider associated costs, where you understand that you are participating in a market where you see that there's not many participants, and you see a risk deviation, a deviation of risk, and you need to apply a new window in order to hedge your position very, very fast. So what do you do then? How do
Well, like
you skip the obstacle?
generally, what you want is to be in the quotes being passive. Being market maker is like being passive and providing
Mhm.
liquidity at the prices I want, right? You need to cross the spread. Then the market participant who has the urgency to take a position is going to cross the spread because his views are like, okay, I'm going to just pay spot 1% the spread, but they think this stock is going to go up 3%. I don't care. But the market maker is playing for these small, spreads. How is this done when you have like many products? And I will jump later to the option space case. Is you are in the quotes of many products simultaneously, right? And when you get hit on the beat, right now you have a net long position that you need to hedge. So what you do in all these correlated products is just you lower your price, so your ask becomes like more competitive in all the products. So if there is another market participant that is going to come to buy, now you're going to have higher chances. And the longer your position, the more aggressive you're shifting your quotes. And at some point, you will front than everybody else, and then netting your risk, even if with another
So
product.
so it sounds to me that when you're building an algorithm, a risk algorithm, it's less, mathematical in a sense where you need to build the best hedging strategy or where you need to build the best risk strategy, because you're that way or another you're staying passive. But because you're staying passive, you need to have a certain latency limitations, because that what by the way, fix me if I'm wrong, I could be wrong. I just want to understand, but you are trying to minimize latency gaps as much as possible in order to preserve that hedging that you were structuring to yourself initially. So my question right now is, let's take that conversation onto the world of software, and I want to understand. how do you program a software where it's enough rapid to provide liquidity to make you remain passive and still will not harm your initial hedging strategy?
Yeah, I think what you refer to is the fact that, let's say, in panic moments, right? Everybody's a seller, and then you're a market maker just only buying. There is no genuine flow buying at that time, right? And then you just accumulating loan risk. First of all, if that happens, you're gonna demand more spread, so you're gonna be widening your quotes. And second, if you really get hit in size, for instance, and you're accumulating too much risk, you must just become aggressive and aggressively cross the spread to sell, and you will choose a product that is suitable. So imagine that you you're just seeing that, in this example of all the banks and Delta One example, that they are going down, but one is like lagging, right? And you're accumulating long positions in many other banks. Well, you might just go and hit the bid and offload, your risk in this bank that is lagging, right? Which probably will, revert to where it should be statistically. So there are times where a market maker, to satisfy their risk, just crosses the spread, but generally that is not desired, right? Because generally in the professional market we have nowadays, generally if you're trading against another market maker, it's not a good sign, right? It can be a good sign if you have very different positions, and of course you need to do it by risk reasons and react fast. But generally the general framework is that you want to cross the spread as less as possible, because your business is capitalized at the spread actually.
Mhm. Yeah, well, I understand, but what happens if you trade with or against another market maker? Because, like larger markets demand larger liquidity providers, and larger liquidity providers bring on more and more and more attention and less opportunity. And the one who finds the opportunity wants to jump in, which makes it very like a major red ocean for market makers in general, but a very, very tempting opportunity to jumping on, I think. Um, my question to you is what happens if you are not capitalized to the spread in a sense where you're the main market maker in the market, but where you another market making participant?
You mean like what happens if you're the largest market maker in the market, or
Not the largest, but one of the largest. Yeah, in the same market, participating in the same market.
meaning that you might not find where to offload it? uh,
Could
in
be.
that,
Yeah, absolutely.
in that sense, well, generally what happens is that the really big market makers just trade all kind of assets, and they find positions that are, let's say, comfortable, and it's still like in products like equity indices, you can hedge a huge size, right? And normally if you're too big, they say that you put the price that is correct. The market, it's just likely that the market goes against you because you're too big, and it's going to stay where you are, right? So that is an advantage of larger market makers, I would say.
Hmm.
They have they have more venues to hedge, like huge markets, like great markets, like equity indices markets, where not everybody can quote on equity indices. It's a super competitive market. um, so yeah, they have many resources to offload, and also because of their weight, the price tends not to play too much against, right?
Hmm.
So being large has its own advantages and protections naturally
Hmm.
in that sense.
Um, that's very interesting. My wonder right now, aside of the very market making topic that we chose to write over, I think it's the way of creating or generally speaking about transaction costs and associated costs in general. I would like to understand how do you position yourself in a way where you understand that you are capitalizing a spread in a very particular market, as you said, but not just capitalizing a spread, but you understand your capability or your margins and how your margins are actually being preserved, even
Hmm.
if market conditions are actively changing, and market conditions that are actively
Yeah,
changing because you provide liquidity to that type of request. And my question is to understand counterfactually. You know what? Let's
yeah,
speak about counterfactual occasion. What will happen if it exists, or what happen if it doesn't exist? Like a major component in your strategy. How do you know how to bench between the two and to stay and remain dynamic even if market conditions are actively
yeah,
changing?
yeah. Sure. I mean, obviously, market making is the most difficult task a market participant can do. So you really need to know really well the market you are market making, right? You need to know statistics about how much it move, like which is the risk in different scenarios, how much the position can I take for the capital I have. So you need to
This is
have
an approximation. This
and
is an approximation. This is a kind of an approximation, or this is the stats that you receive from
what
the exchange that we're asking your service.
well basically you just know historically, like with the price moves, what would have happened if you take certain positions, and then how much it takes for you to get out. And a good metric in that sense could be like the margin retention, right? Like the initial edge that in the example I gave was 1.5. Okay, how much of that I retain until I'm out of the risk, right? Or basically, you could measure that if you trade many products as how much money is retained from my initial P&L, right? So if you know the market, you know how tight you can be, and you should not try to be as tight as other market makers just because they are there. You need to know, okay, your system, your risk limits, and your ability and markets to allow the risk. And the options space, what you have is that for every single product, you have many maturities, let's say 8, 10, and every maturity has many strikes, and you have calls and puts. So what happens is, like, for every, let's say, stock, if we talk about equity options, you have probably hundreds of options, right? What does it mean? Like, you have a lot of products. What happens is, like, obviously these options are correlated as derivatives to the underlying, and the underlyings are correlated among themselves. So there's a lot of correlation on that space. Now, how much margin you should ask, knowing that, well, particular option is liquid, and then you need to know the liquidity of the product if you want to hedge, let's say, one option in the maturity 1 month with an option on the maturity 2 months. uh, you generally need to know, like, how much will cost you to close it, let's say, immediately, or statistically, if there is enough flow to just wait and close it naturally by the market. What I can tell you is that in options, um, because the the market makers that operate on the options space, all they do is generally volatility trading. Volatility trading, what does is, the very first thing is eliminate the delta risk, eliminate the risk that is associated with the underlying moving away, because it's the strongest risk there is. There are more risks, but this is the strongest. So you need to hedge the delta. Well, the question is, all right, someone sells me a call and I need to sell the stock. How much is going to cost me to cross the spread on the stock and react while the stock is moving?
Mhm.
This cost is not going to be the same for an option that is delta 60 that for an option that is is delta 10, right? Because the price of the option, of the delta 60, is much more sensitive, so you need to react faster. Therefore, you need to ask more margin for the delta 60 option. The same can be applied to other type of Greeks, um, uh, of the option, right? Like gamma, Vega, and even second order, if you ask me, like Vanna, Volga. So the more Greek aggregated risk an option has, the more margin you need to ask, because there are many factors that can change the price while you have not hedged it. And it depends also on the product, right? On indices, market is super tight because there is a lot of genuine flow. You can trade other maturities, slightly different delta, and you're going to be, partially statistically hedged, right? So it all depends on these factors. There are even products where you need to ask a lot of hedge because it's probable that you carry the position till expiry. There are cases like that where you are almost acting as a passive position taker, if you ask me. Delta hedging, because the beauty of options is that one market participant can have a strong view on a stock going up 6 months out and is buying a plus 30% call, and maybe he's paying a very expensive vol in terms of how much the stock is realizing as a standard deviation of returns. And maybe he's right, the stock goes up, but if it goes up slowly, the vol trader or the market maker who's selling the option can also make money because it's hedging the delta daily, therefore buying the delta daily and also making money. So
Mhm.
there are these type of scenarios, and the variety of products. And again, my experience comes mainly from equity and options. Liquidity can be very different, from the small cap to the index, which is, if you want to quote at the money options on an index, you really need to have incredible system, incredible traders like to be ready because it's super competitive.
Look, I would not call myself an ignorance of an understanding of a type of question that I wanted to ask, but outside of a minor ignorance, because I don't sure that I know the answer, or I'm not sure that I know how to think about the question that I'm going to be asking you, is I want to understand perfectly about the intersection between market making and sizing, because right now you were speaking about, like, hedging a position where you have a stock and you need to provide liquidity because you're knowing that, or you have a certain prediction or a certain stat that's going to be rising in 30%. Right now you want to understand how much to, or where, or how to position, to size your position. And my question is about the intersection, because you're ongoingly sizing your positions and ongoingly you're delivering more and more and more liquidity. So accumulation of size
Mhm.
and sizing positions is going to be, it actually coming into the perfect intersection with associated costs, and it come with a perfect intersection, and it intersect perfectly with, as I said, associated costs, not just associated costs, but your hedging and how you hedge your delta and so on and so forth. But I think obviously size is one of the major components that market maker is supposed to look at. Again, out of like, my understanding from the call, not just not a thing that I tend to understand it. And my question to you is, what do you think about it?
Yeah, well, size is like really key, right? As you mentioned, for a market maker, like it's this, risk discipline. Otherwise, you're just gonna get destroyed very soon, right? So you need, size limits, almost like per trade, product, group of products, and company, right? And as a market maker, you basically accumulate risk and thinking a company with several traders or desk, all need to be coordinated, right? Especially if these products are correlated, right? And what you generally do is, okay, I have these risk limits, how much I can put on my quotes, and knowing, okay, if there is a trade or there is a market tick, how much I will be, let's say, buying or selling, I will be ready with, a better price for me with a particular size. Generally, you don't want to start trading too big. You sense the market. If the price gets better, maybe you want to go a bit bigger. But keeping in mind, which is the general trajectory of the price, right? If we're talking about, let's say, vol trading and a particular equity stock, I say, well, it's trading about 40. If an aggressive series of sellers come, it might go down 3 points where I will just do a lot at that level because I think it has deviated too much and it needs to revert, right? But you kind of keep in mind. And the thing is, if you reach certain level of risk, even if you hedge it statistically, there will be no more space for you to take more buys. So let's say every time I'm buying a particular large cap, let's say against a bank, and I'm hedging with the banking index, for instance, or Euro stocks or S&P, I can do this spread up to a certain limit, because at some point, it's not that the hedge is perfect, and if things blow up, I can suffer a loss I cannot afford, right? So you have some risk limits, and at some point, even if you are market making, you just might be off of the bid. You cannot buy more. You hit your risk limit. There might be a seller in the market that was too strong, and yeah, the prices are nicer now, but you are in your risk limit. And if you want to continue trading, maybe you need to sell on that particular product, maybe other maturity or things like that. Like that allow you to say, well, my risk limit in this stock A was 10K, whatever. I will sell any other maturity, so I still can satisfy what the risk department is, uh, telling me to do, right? So you need to keep some discipline on the risk, because as a market maker, you need to be really under control. Otherwise, you just will blow up. You need to know very well, um, in a variety of scenarios, how much risk you will be taking, how you're going to be hedging. All that is predetermined. You're not inventing anything on the way. Everything is in a very disciplined, let's say, framework.
Mhm. Very interesting. Very interesting. Look, I um I have another question, but that question is going to take us away a bit from the conversation about, like, how to position, how to size, how to edge, and so on. It's going to be back to the business itself, because the business, I think, it's the authority that determines literally everything. When you are getting a call for an exchange from an exchange, I want to understand, how do you start working with them? How do you build a relationship as a market maker with the exchange? What type of markets do they ask you to provide liquidity to, and how do you know generalize your understanding about the market, besides like understand the stats of the market, how much it moves, and so forth, as we have already discussed. And how do you build a business plan that explains, describes perfectly, articulates your business goals with that exchange over a certain way of time, and how you as a market maker knows how to derive information from it. So this is like a classical reverse engineering question that I want to ask you, because now going from the business, understanding the business criteria, to take it to everything that we have already discussed over.
Yeah. So if you want to trade as a market maker, generally what you have, exchanges provide special pricing and connection for market makers, liquidity providers, right? Because that's what they need. A liquid market where market participants find narrow spreads, and that generates more trading on that market and more revenue for the exchange, right? So basically, what you will have is that market makers connect directly to the exchange. They get all the trading data. Of course, there is a fee for that. You acting as a market maker, but also on turn, you will get uh, either rebates or lower fee tire on the exchange, and you will pay a fraction, literally a fraction of what any other market participant pays to trade. Obviously, because just keep trading all the time, and if you will need to pay normal fees, there will be probably no business for the market makers nowadays, how tight are the markets, right? So in that sense, the relationship with the exchange is, the more, let's say, the more products you quote, and there are a minimum, right? I can say, okay, I'm going to quote this product, but I'm super wide. No. You need to be in a certain max spread, which has some flexibility around, panic events, that the market, that the exchange established, like, okay, you need to be quoting a certain amount, like 95% of the time in this spread, in this category of products, you get this rebate or this fee. If you include also these products and this spread, this percentage of time, you get these other fees. So the bigger you are in the market, the lower your fees are going to be for that exchange. And it becomes like really interesting if you start trading a lot of products. The connection that you pay to the exchange it's just like a fixed cost, and the execution costs you get are like really small, and then you're just gonna be focusing on the market risk. So that's a bit the process. So starting, um, if you will say start, probably what most market participants do is kind of acting like as a, observing the market, and being there for some positions, or quoting only a region or a particular maturity of small set of products. You start small. When you're under control, you span the strikes, you span the maturities, and you span the product. So in that sense, like, you start small, and I can tell you that nowadays, you need to have a certain view of the market. You just cannot go just quote for the sake of quoting. You need to have some small view. So I don't know if that answers the question.
No, it answers, and it answered the question perfectly. I think that there is no certain morphical response to the question, because it's a major challenge. It's a major challenge over and over time you understand the challenge itself. But I would like to understand from your world in option trader, um, about hedging the Greeks, not just hedging the Greeks, but working with the Greeks. So I see the Greeks as a toolbox. And like as you mentioned, there's alpha, beta, gamma, delta, and so on and so forth. And and my question is, how do you know how to utilize that toolbox of like exposure to beta, exposure to hedging, how much you tend to expose
Mhm.
yourself, and out of that toolbox, how do you take the Greeks and apply it within your statistical models? And how do you know how to utilize it, how to fine tune it perfectly in order to understand and in order to utilize your trading strategy better? Because this is a thing that everybody uses. And when we're talking about thesis, and when we're talking about exposure to new ideas, and when we're talking about like other areas of that particular world, we all use the same thing. We all might be using the same idea to reach different paths within our chain of thoughts. And my question to you, Antonio, not to you, like as a part of the company and so on and so forth, but to you. But how do you think about practical utilization of the Greeks in option trading?
Yeah, I think here, the difficult part that you will see is like when someone joins a firm versus someone who's been years trading, is that this whole Black-Scholes model is a nice theoretical framework that allows to simplify things, right? And these Greeks are the outcome of that simplification. I can just summarize the problem or my risk in few parameters, which is essential, right? The Greeks, because they are like linear, they just add up, right? And then, as I told you, you might have like hundreds of thousands of options, right? And then your portfolio, because so many products, so many strikes, and you have positions in many of them, it becomes a really, really complex portfolio position. So you need ways to summarize it, and the Greeks are satisfying really well that matter. Now, what happens with the Greeks? You really need to understand to the core what do they mean and what do they not mean, right? You just cannot go by the book, right? I'm gonna give you an example. You have Vega, uh, like, obviously a long-term option, like 1 year option, will have more Vega than a 1 month option, right? But at the same time, the implied vol of a 1 year option rarely will be changing as much as 1 year out, right? Oscillation of the implied volatility. Now, you say, well, I'm Vega hedged, but maybe you're not hedged at all, right? You need to understand where you can use these Greeks and the cancellations and what not, right? And it's not the same also a product that is trading an implied vol of 100 than a product that is trading an implied vol of 12, right? So in the same way that you need to use Black-Scholes knowing its limitations and it is a wrong it is like a wrong model that allows to, well, operate in this complex product. That are options. You need to understand the Greeks, you need to understand the limitations, and from that point, I think every trader or firm establish its own framework. I mean, generally things that are used, like as I was talking, the Vega, normalized Vega, or even normalized gamma, respect to how much the actual stock is moving. And what you try to do is understand what cancels what, because that enables you to keep taking positions, right? If I know that 80% of my risk with position A is canceled with position B, and I see an opportunity of trade position B in the market, well, I'm going to trade because it's going to cancel my risk. And you do all this via Greeks, right? Because with these Greeks, you are explaining this super complex position in just like, few numbers, and it allows you to keep operating because it's too complex. Like nobody could operate in a portfolio with thousands of positions. They need to summarize, and then and there are hidden risks, right? Like because the Greeks are going to be static, as the underlyings move, your position is going to change. There are like more orders, and of course, like the more sophisticated your system, you might be looking into uh, how degrees change, if this or that. But basically, all summary is like units. Is like a let's say a standard unit that everybody understands and traders can speak among themselves in a common language. Because what is behind is way more complex. It's as any model in physics or engineering. It's just simplifying a reality. And the good users of that model are those who understand the model, understand when it's valid, when it's not valid, where are the risks of the model, and things to take into account. And those who dominate that, they can, operate in a simplified manner. But I've seen many times, some people really like, they just think, oh, this is like aggregated Vega or gamma or whatever. But there are implications that you can make use of this simplified model.
Mhm. That's I think a point you have touched a point where people are trying to realize over and over and over again how much they're hedged to Vega and how much they're hedged to Delta and so on and so forth. But summarizing major amount of data, which is big data because it has major components that are not correlated, and you cannot normalize the data into one numerical expression. That makes a lot of sense. And not just by making a lot of sense, but understanding data, or understanding your positions. I think it's a major pain point that people are actually facing by their day-to-day job. And my wonder with you right now, Antonio, is that I want to dive into the world of the portfolio management of a market maker. Like you might be having tens of different thousands of positions, I might guess, but tens to hundreds, I think it's the normal
Mm.
amount of open positions that you're going to be holding. And I want to understand the macro picture. Do you look for correlation with your positions? Do you look for hidden delta hedging within the positions? Do you look for, patterns that you aren't able to expose from the market, but you are able to expose from your positions because you build the positions, what you have every particular position within your portfolio, and you want to and the expression or approximation of a pattern might be giving you a different perspective. So I want to understand, not just by looking and taking one position, but taking multiple positions into one portfolio, expressing and extracting patterns, or not just expressing and extracting patterns, but correlations, inverse correlations, co-movements, so on and so forth. Like, we can talk about many matrices that would be relevant. And my question is, how do you work in a portfolio level by understanding every position that you have within your portfolio?
Yeah. I mean, here it all depends on, let's say, the complexity of the company portfolio trading system you deal with, right? Um, let's say if you're small and you're trading just certain universe that you have determined, uh, you basically you know which are your risk limits, and it's better if you have, let's say, some signal in that universe that telling you, okay, at this moment in the market, I prefer to be buying this and selling this, so you don't get taking advantage of toxic trades, which are like trades with good information, meaning that the one who is taking is on the right side of things, and therefore you're wrong. Um, Now, on the cancellation risk, what you want to know is all these different, options, maturities, strikes of different products. How are they correlated normally? So you want to do some quantitative work. I mean, I think nowadays is almost mandatory to do some decent quantitative work, and knowing that statistically, uh, how this risk is going to cancel. You need to know well your products, meaning that if you know if you have determined that actually there's some cancellation, your risk cancels, right? So you can say, okay, my top risk is this, my individual sub risk, I also need to allow them to a certain limit. You cannot go 1 million long, 1 million short just because they are statistically correlated, because if this correlation breaks in a moment, you might blow up. But, it allows you to take, bigger positions and trade more in the market than some person that is not, considering these cancellations, right? This can get even more complex if you have you know a setup where you have many traders, many desks in different subsectors of groups of products, where you're trading, let's say, your universe, but you have another desk in the company which is trading another universe. There should be some person looking to the cancellations that might happen between those groups, because maybe I'm too long, and instead of going to the market and crossing the spread and therefore paying another market making this spread, I may cancel with a desk in my company. Like this type of more sophisticated environments with internal markets are what I would say a more developed market maker does. And in that sense, you could have such level of sophistication that the delta hedging is carried out with a particular team. It may be right, because if you're an options trader and you need to do your delta, well, I mean, nowadays, like algos do practically everything, right? But okay, let's say all this delta risk needs to be executed in the market, right? And in the same way, options have a market making business. Delta one or stocks or futures have also that business. So if you're crossing the spread to hedge your delta, you're also losing edge. So you might have an internal market or desk which gets all this delta risk and says, well, if I need to buy Euro stocks and sell S&P, well, I might just keep this spread and not trade in the market, because in the meanwhile, the options traders might send me the opposite deltas and the cancellation happens internally. So that is where a good framework of understanding correlations, betas, uh, how all these pieces fall statistically together on this Tetris allows you to trade more internally, and therefore to trade less in the market. You have less friction and you keep more edge to yourself. Now, you need to do this, very consciously, carefully, and well researched, right? Because obviously, if these assumptions break, you're taking too much risk compared
Mm.
to, let's say, closing into the market.
Look, my hypothesis is that there are a lot of, I would not use the term, but I'm forced to use the term, but hidden gems in understanding your current positions and in understanding your current portfolio and the amount of hedge uh, and the amount of edge now it's been hidden in between the positions that you're having open within that portfolio. And my approximation here is that most, and not just like, talking about market makers and option market makers, but talking about, general portfolio managers, they have a bit of a hard time understanding, the potential occasions of what were going to be happening with their own portfolios. And that's my hypothesis. And that's a problem that I see growing. dramatically right now. And I do see that there is a lot of innovation in space, but still there is a lot of hidden cap that it's been still remain unopened, unclosed. I'm sorry, and yeah, I really relate to what you're saying is that it has to be well researched and well and well understand before or during the research type to get yourself the brightest information, because I think that internal information is not being consumed as external information, and external information is being validated much more than internal information, and internal information is not being valued as much as it needed to be. And people are actually living going to the table, and I see it as a tremendous problem that's actually taking place in today's portfolio management markets. Um, Now, going back to our conversation, um, let's talk about right now. We have been spoken about options, and although it's a very fascinating world, I would like to take that conversation into not just market making and not just options, but to the more of an academic world, because you were mentioning that you were enough ambition to leave the academia, and I want to understand from your perspective about the academia. How do you see the involvement? How do you see the research right now taking place? How do you see the you know the directions that those institutions are actually taking to search more capabilities, and how much they're exposed to data in order to make proper research pipelines? That's another great question, because not necessarily they're exposed to something. So let me get your 2 cents about it.
Yeah. Well, I mean, I did my PhD like in another topic, like I did in computational electromagnetics, designing antennas, and so on. But basically, I know academia, I would say, pretty well. And I have read a fair amount of books and papers related to options, theory and research and trading research. Um, what I find is that, unfortunately, it is a field. For instance, in engineering, I think there is more transparency, but there is not much information about, let's say, practical trading in a book. I I have a difficult time finding a book that says, all this minor information that you really need to know. So because of this disconnection, what you will find is that, when you work in academia, and especially if we're talking about, mathematics problem, everything has to be very elegant. Everything needs to satisfy many conditions, and sometimes that elegance of a model is disconnected from, the practical sense, of what you can actually execute or trade in the market. Because you might come with, there are few, I say, very elegant, theorems, and models around options that they look very good, but some of them cannot implement it like in an easy manner in practice, because maybe you don't have the liquidity in all those strikes. That your hedging capabilities are whatever they are because of liquidity, the algorithm that is behind, etc. So, the better you understand the theory, you're going to be in a strong position, right? I seen that. I seen from more practical traders that they don't want to know about the statistics or maths, to the more, let's say, quants. And well, like, it's like a tool like any other. It's not that one is better than the other, but if you have that tool and you understand all these models, you can use them with their limitations in the practice and the market you're facing. But if you don't know the market you're facing, I can tell you, it's likely you will get destroyed. Like, I will consider, if I have to choose, it's more important the practicalities and understanding the market you're operating than the theory. Say that if you can combine both, it put you in a very strong position. And I mean, I've seen that a lot in, all these models about realized volatility and this and this and that. At the end, for instance, in this topic of realized volatility, you need to understand what is the volatility you can realize with the hedging you can do on that particular product. You might use a model that is, a general formula or whatever. If it fits well to your reality. And it's fine because someone has researched it and maybe has some nice properties. And if it fits to your reality, the work is done. But you need to be very careful. And this is the same with the Greeks, right? I mean, Black-Scholes, I mean, in all the books, like you don't have this term structure moves in correlation and the smiles move in correlation. Like, I mean, capturing that, like with the Greeks alone, is difficult. So you can use a simplified model, knowing in the back of your head that you're doing the necessary calculations to adapt to this reality. So in that sense, there is this a little bit of disconnect because you have very few people who are very active, strong academic researcher or professors who also have, I don't know, 5, 10 years trading experience in a prop trading firm, hedge fund, or similar. You have few cases, and those people are probably, going to provide a very good input. But the majority of the cases, you have some person who is putting the effort in, his or her academic career, and it's a lot of work and it's very difficult, right? You need to be focused in a very narrow field, but has not, practicing experience, right? And at the same time, you have someone who just joined fresh graduate as a trader and has incredible knowledge about the markets, etc. But maybe these concepts from university are not that fresh, and this person, this trader in particular, might not care that it's not perfect. It just works. I mean, traders work constantly with simplifications, which is hectic market with a lot of buts and small details that you need to be really fast, flexible, and I mean you need to know the basics. But sometimes what you will find on these papers are that there is a gap between the paper and the reality. This gap is smaller, obviously, in super liquid, almost perfect, efficient products like indices, right? XP 500 options, option chain and market, you know, will be like more connected to the theoretical ideal framework versus like some small cap, in a complex sector like pharmaceutical. Well, probably would be quite more disconnected in that sense.
Mhm. Yeah, well, the world of quantitative research in academia, and by the way, you can see it in archive by Cornell University when you go to quantitative finance, you see that it's not very rich in terms of like understanding market microstructure. And I think that the data is actually being preserved to the best hedge funds, and there is no major exposure to other resources. And this is, by the way, one of the why that I'm doing that podcast, to get more people to congregate with each other, and to get their ideas to congregate with each other, and to see how they can actually work. Um, but I really appreciate, by the way, what you're saying about the tools and about how to use the tools from academia into the world of the actual industry. And I think that understanding about how to make that intersection would work, because academia is misleading multiple times. So I can testify myself that a couple of years ago I was doing a product or a project on top of reinforcement learning with PPO in the financial markets. It was disaster. It was a complete disaster, and you probably can understand why. You are unable to assign to the clip in the equation whatever value, and the markets are chaotic. So PPO is not a very reflective solution, and you can see like how the approach of you know of the world of academia is actually trying to approach it in a very, very creative ways, but not in a very practical ways to the actual industry needs. And I think that there is a certain distinction here that we would have to realize its existence. And okay, now let's go back to our conversation about options. Um, and let's try to understand how to take an advantage on top of research. So what do I mean? I mean that when you're trying to have a new strategy, or when you have an idea to approach a new market, What is your research pipeline, Antonio? What do you approach first? How do you approach first? What is the research tools that you're actively using to understand the underlying mechanisms of the strategy that you want to they want to approach? I think it's a great initiation for a research process.
Yeah. Whenever I have done research, and this I learned quite a bit on my PhD, and I have applied through my career in trading, is first when you tackle a problem, you want to spend quite some time, look into the data, understanding what question you need to ask and what question you need to ask to the data. And if you're exploring, let's say, different features of parameters, just do a wide exploration. And me personally, I'm a very visual person. I like to do a lot of plots, right? And try to see some, relationships of pattern. Right now is everything is very diffuse, very, expanding, right? The first stage of expanding. Now, and this especially if it's something completely new, right? Maybe you given a problem and you need to do an improvement. We're talking a different, level of, witness here, right? But if you're giving something absolutely new, you have no idea how, to generate the edge. You start saying, okay, what I need to do to ask to the data, what I believe from my previous knowledge this could work or not, and you do something right. Now you find maybe two, three things that might or might not work, and then you explore them in depth, and then you start building on that. So you go wide and you go narrow, and you explore many things. And me personally, I really believe that, I mean, unless you have a clear mandate to replicate something that works, if you're creating something new, I try to think, okay, how I could look into this data in a manner that is not conventional, like it's not like even written every book. Calculate this and you will make money. That doesn't work, right? Because you have many smart people around there who is looking to this data. So what you want to try to do is try to put your, own, piece of salt like coming from you, like your custom type of, calculation or thing that is a bit genuine. And I guess that you need to have some sort of, sense of creativity, and from that point you build, right? And you need to understand that, especially if the problem is a bit blue sky, like something new, you might find that in many cases the answer is, well, this is not the solution. There is no solution to this particular thing now, right? You need to try another thing. But that would be the process. And in my experience, you might find a wall a couple of times, but then when you're trying these things, if you spend enough time with the problem, at some point something clicks, and then you try and you build something with, certain degree of success. So that's what I would consider. And I will, you know something is like, you don't want to overcomplicate it, but again, you want to think a bit ahead of whatever is written in every book, or whatever is known by everybody. So, and at some point focus, right? You span, but at some point you need to focus back, because you could get lost on all that research. Yeah.
Mhm. There's a thing that's misunderstood right now, which is about, that sweet spot between engineering or researching to over researching or over engineering. And that happens quite a lot. And understand the distinction where you over optimize, as an engineer or as a people who think, you are incentivized to do this, but not necessarily it's the right approach to it. And my question to you is, how do you know how to differentiate between or how do you know how to identify or to detect that sweet spot when you're reaching it? So you said narrow, going narrow after the expansion, understanding. Brilliant. This is great. But right now, where do you stop? Where is like the hard stop of the research pipeline that you define to yourself?
Yeah, um, I think that in that sense, like I think one of your guests, like Erin Beatty, mentioned something similar. Um, you know, this problem generally arises when you have different teams, right? And then one team is disconnected with the trading, right? And this can be engineering or it can be quant researching. Let's say quant researching is absolutely disconnected with trading, right? Which, I mean, in my experience where I have worked, it's not been the case. But if it's that the case, I mean, someone can research many things that, okay, are you able to trade that? That's the first question, even way before narrowing the research. Even when you're doing this expanding research, you should try only things that are tradable, right? I I don't care if you find a pattern, a beautiful pattern or correlation in something that is not tradable in the market. Let's say there is no market for that. You cannot trade that. That, oh, when this happens, I will buy this. Yeah, but let's say the market is super wide, and you cannot execute that price, even the fair price is this or that. Or maybe there's no liquidity on certain particular strike area. You cannot you cannot trade that. So
Hmm.
so I would say in that sense that there should be a good communication, especially if some team or some person who is not per se executing the trade needs to develop one part. It needs to be clear what is the end goal, right, of this. Like if the end goal is trading this and make a profit from this, well, let's do a pipeline that focus on that and not deviate the research or the engineering on the infrastructure in things that are you know not actually usable by the trading system
Hmm.
or the trading strategy. So
Hmm.
that's something I've seen, sometimes, like finding patterns or, you know, beautiful signal or relationship between some stock options and the other, or implied vol, realized vol. But okay, it needs to be tradable in the market. So that's what I would say. And this is like first thing, you need to be clear what are you trading even you start gathering any data. And this
Hmm.
is like even the steps I describe, take this already this for granted, meaning that when you're exploring things, you need before that you need to narrow to whatever is tradable.
Hmm. Absolutely, absolutely. Look, I think. By the way, Antonio, I really want to thank you for a very insightful conversation. I think that we have covered much more than we planned to do initially. No, fix me if I'm wrong. We haven't captured anything about crypto, but I feel good with it. I feel really
I,
good with it.
yeah. I mean, I think that crypto is an interesting space nowadays. The option space in crypto is growing more and more, and I think the interesting part is that I think sooner than later, crypto and equity and other markets all together are gonna become one. And
Really?
yeah,
No, 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 no. So you would have to explain yourself right now because this is going to be interesting.
well, I mean, with the tokenized assets, right? This is gonna be all this is gonna be over the blockchain, right? So I think blockchain is gonna gain relevance in the coming years regarding to market and market access, liquidity, etc. Right? So I think in that sense, the markets now that some people consider disconnected are gonna be more integrated, and the possibilities for market participants and liquidity providers are going to be like nothing we've seen before.
Going to unite, in a
Yeah.
sense. To
Sorry.
unite, to unite,
Yeah,
unite.
yeah, we're gonna see tremendous efficiency in the markets, tokenized assets. Like I think great times for markets trading and options in particular. Definitely.
So when I'm having recording sessions, probably the last question would be, where do you see the markets in the next few years? You understand, you gave me your perspective before I was able to ask, so I'm very very happy about it. Antonio, I want to thank you for a great conversation. I had a pleasure to have you. I think that the conversation entirely from end to end was incredibly interesting. And again, I want to thank you for coming. And it was a pleasure. It just was a pleasure.
Thank you to you. In fact, I enjoyed really much talking and having this conversation. And I'm looking to the clock, and time has like a flight. So it's been really a
So I'm going to
pleasure.
be taking it as a compliment.
No, yeah, yeah.
Yeah, okay. Okay, so brilliant. Antonio, again, many thanks for your participation. For all of the listeners that remains to this level of the conversation, I want to thank you for listening. And thank you, everyone. Thank you, and see you in the next episode of the Washington Ones.
Thank you to everybody.
Bye bye.